I'll try to break this down a little more in granularity. Let's see what the RBI has done over the last 3 months. They've hiked interest rates by almost 140 basis points, which is 1.4%. So we've looked at an off-cycle meeting in May, which saw a rate hike of 40 basis points. We saw June a 50 basis point, which is 0.5% rate hike. And we saw in August as well another 0.5% rate hike on the repo. And what this means for banks is that as rates go up, the loans start getting repriced. And what component of those loans are floating loans, which is what will really get repriced. So of course we have HDFC Bank with 54%, we have Kotak with 70%, ICICI Bank with 70%. We even have the likes of Axis as well as IndusInd as well as Federal Bank, all three above 50% of floating rate loans, which means that some of these loans will start getting repriced or have already gotten repriced to a certain extent. At least the 90 basis point hike in both May as well as June would have for most banks already been passed through. So how does this impact the pocket of the end consumer? So let's start off with pre the hike. If the EMI for your home loan of 50 lakh rupees, which is a 20-year tenure on that loan, was roughly 38,000, we saw a 40 basis point rate hike, which would increase your EMI by 3%, another 50 basis point rate hike in June, which would increase your rate by 7.2%, which is your EMI rate monthly, and 11% after the August hike. So we've seen across the board how your rates have started to go up. Now on a cumulative basis, the interest that you will pay out as a customer would go up at the end of August by 25%. So your 41 lakh rupee total interest over the 20-year tenure would now currently stand at 51 lakh rupees. That's the real impact of the rate hike of just 1.4%. Going forward, of course, we'll have to wait and watch what the RBI does.